Welcome to your guide on avoiding costly stock market mistakes. Today we're diving into the top 7 errors investors make. By learning these, you can protect your money and grow wealth. Let's start with mistake number 1, chasing hot trends. It's tempting to jump into stocks everyone's talking about. In 2024, artificial intelligence stocks dominated headlines. Companies like Nvidia saw gains of over 190%. But chasing these winners can lead to buying at peak prices. When sentiment shifts, late investors often face sharp losses. This is called the hot hand fallacy, assuming winners keep winning. Instead, focus on companies with strong fundamentals. Look for steady earnings growth and competitive advantages. Research before you invest, not after the stock's already soaring. Diversify across sectors to avoid being tied to one trend. This approach reduces risk and keeps your portfolio balanced. Mistake number 2, trying to time the market. Many investors think they can predict market highs and lows. In April 2025, markets dropped after new tariff announcements. The S&P 500 fell over 10% in just 2 days. Some sold in panic, hoping to buy back at lower prices. But timing is nearly impossible, even for professionals. A study showed missing the market's best 10 days cuts returns in half. From 1990 to 2020, those days often came after big drops. Selling during a dip could mean missing a rebound. Instead, stay invested for the long term. Use dollar-cost averaging to spread out your purchases. This means investing a fixed amount regularly. No matter the price, it reduces the risk of buying at the wrong time. Over time, this strategy smooths out market volatility. Mistake number 3, ignoring diversification. Putting all your money in one stock or sector is risky. Tech stocks led gains in 2024, but crashed in early 2025. Investors heavy in tech suffered major portfolio losses. Diversification spreads risk across different assets, include stocks, bonds, and even international markets. International stocks lagged US markets for years, but in 2025, some predict they'll outperform. A mix of large and small cap stocks also helps. Small caps took a hit in 2025 due to high borrowing costs, but they often rebound faster in recovery period. Aim for a portfolio that balances growth and stability. Mistake number 4, letting emotions drive decisions. Fear and greed can wreck your investment strategy. When markets crashed in 2022, many sold at the bottom. They missed the 53% S&P 500 gain by 2024. On the flip side, greed pushes people to overbuy and bubble. Stick to a plan based on your goals and risk tolerance. Set clear rules like rebalancing your portfolio yearly. This keeps emotions in check during market swings. Consider working with a financial advisor for guidance. They can offer an outside perspective when emotions run high. Mistake number 5, neglecting research. Buying stocks without understanding them is a gamble. In 2025, tariff policies hit tech and consumer sectors hard. Investors who didn't study supply chains lost big. Check a company's financials like revenue and debt levels. Read earnings reports to see how they're performing. Look at industry trends and macroeconomic factors. For example, high inflation in 2025 raised costs for firms. Companies with pricing power weathered it better. Free resources like company filings are a great start. Mistake number 6, overlooking fees. High fees can eat away at your investment returns. Some mutual funds charge over 1% annually. Over 30 years, that could cost you thousands. Index funds often have fees below 0.1%. They track markets like the S&P 500 at low cost. Check expense ratios before buying any fund. Also, watch for trading fees on brokerage platforms. Many offer zero commission trades, so shop around. Saving on fees leaves more money to grow over time. Mistake number 7, not planning for the long term. Investing without goals is like driving without a map. Short-term trades rarely beat long-term strategies. Since 1929, the S&P 500 averaged 10% yearly returns. But that's for investors who stayed in for decades. Define your goals like retirement or buying a home, then build a portfolio to match your timeline. Younger investors can take more risks with stocks. Older investors may prefer bonds for stability. Review your plan yearly to stay on track. Now let's dive deeper into avoiding these mistakes. Chasing trends often stems from fear of missing out. Social media amplifies this with constant stock tips. In 2021, meme stocks like GameStop surged overnight. Many who chased the hype lost money when prices crashed. Focus on value, not buzz, to build lasting wealth. Look at metrics like price-to-earnings ratios. A low ratio may signal an undervalued stock, but don't rely on one metric alone for decisions. Combine it with qualitative factors like management quality. This holistic approach helps you avoid traps. Timing the market is another common pitfall. Even experts struggle to predict short-term moves. In 2020, markets crashed, then soared unexpectedly. Those who sold in March missed massive gains. Instead of guessing, focus on time in the market. The longer you stay invested, the better your odds. Compounding works best over decades, not months. For example, $1,000 invested in 1990 could be worth over $20,000 by 2025. That's the power of staying patient. Diversification isn't just about stocks. Bonds can cushion losses when stocks fall. In 2025, bonds gained as stocks dipped. Real estate or commodities can also hedge risks. Gold hit $3,000 an ounce in 2025. It's a safe haven during economic uncertainty, but don't overdo any one asset class. Balance is key to managing ups and downs. Emotions can be your worst enemy in investing. News headlines often fuel panic or overconfidence. In April 2025, tariff fears sparked a sell-off, but markets later stabilized as fears eased. Tune out short-term noise and stick to your plan. Automate investments to avoid impulsive moves. Set up regular contributions to your accounts. This builds discipline and reduces stress. Research is critical, but it doesn't have to be complex. Start with a company's annual report. It shows revenue, profits, and future plans. Compare it to competitors in the same industry. Websites like Yahoo Finance offer free data. Podcasts and books can also teach you basics. The more you learn, the better your decisions. Fees might seem small, but they add up fast. A 1% fee on $100,000. Choose low-cost ETFs for broad market exposure. Vanguard and Fidelity have some of the cheapest. Always read the fine print before investing. Long-term planning ties everything together. Think about where you want to be in 10 years. Then work backward to set monthly savings goals. Use retirement calculators to estimate needs. Adjust your investments as life changes. A new job or child might shift your priorities. Flexibility keeps your plan relevant. Let's recap these 7 mistakes. First, don't chase trends without research. Second, avoid trying to time the market. Third, diversify to spread your risk. Fourth, keep emotions out of decisions. Fifth, always do your homework. Sixth, minimize fees to maximize returns. Seventh, plan for the long haul. By avoiding these, you're on a path to success. Investing is a marathon, not a sprint. Stay disciplined, and your wealth can grow. Thanks for watching, and happy investing.